There is a number sitting on your screen right now that almost nobody is talking about, and by the time this video ends, you will understand why it matters more than almost anything else happening in markets this week. Silver has just spent an entire year climbing more than 60%, and yet it still has not been able to hold the $58 level with any conviction. Gold is sitting above $4,000 an ounce, calm, steady, almost boring by comparison, and in the background, a policy deadline that most retail investors have never heard of just quietly passed, while another one tied directly to the metal sitting in your portfolio or on your watch list remains open, unresolved, and fully capable of moving faster than anyone expects. This is not a story about panic. It is a story about pressure. And pressure in economics always finds a release valve eventually. Today, we are going to walk through exactly where that pressure is building, why it is building there, and not somewhere else, and what history tells us tends to happen next. Stay with me because the way this video is structured, each piece you learn will make the next piece hit harder. And the final insight will tie every single thread together in a way that changes how you look at your own portfolio. Before we go further, I want to know something. Comment below and tell me where in the world you are watching this from and whether you personally hold gold, silver, or cash right now. I read these and I am genuinely curious whether the instinct to hold hard assets is spreading the way the data suggests it is. Now, let's get into it. To understand why silver is behaving the way it is, you first have to understand what silver actually is, because most people get this wrong from the start. Silver is not simply a shiny industrial input, and it is not simply a store of value like gold. It sits in a strange, uncomfortable middle ground, half monetary asset, half industrial commodity. And that duality is exactly why its price swings are so much sharper than gold's. When fear rises, silver gets bought as a hedge, the same instinct that drives people into gold. But when industrial demand tightens from solar panel production, electronics, medical equipment, and a dozen other uses, silver gets pulled in a second direction entirely. Right now, both of those forces are pulling at the same time, and that is rare. That is the first thing you need to sit with. Silver is currently being bought as a fear hedge and consumed as an industrial input simultaneously during a year when supply has fallen short of demand for a fifth consecutive year running. When a market is structurally short of physical supply and simultaneously receiving a wave of monetary demand, you do not get a gentle price line. You get volatility, sharp pullbacks, and sudden surges, which is precisely the pattern silver has shown over the past 12 months. Now, let's talk about the piece almost nobody explains properly, which is tariff policy, because this is where a lot of the current tension is actually coming from. In February of this year, the United States Supreme Court struck down the sweeping reciprocal tariffs that had been imposed under emergency economic powers, ruling that the executive branch did not have the authority to impose tariffs that way. Within hours, the administration pivoted to a different legal mechanism, a 10% global tariff under a different section of trade law, this one carrying a hard 150-day limit. That clock ran out on July 24th. As of the recording of this video, the replacement framework, a proposed set of duties targeting dozens of countries, including some of the largest trading partners of the United States, has not been fully finalized. That is not speculation. That is simply where the paperwork stands. Separately, and this is the part that touches your silver position directly, the administration has kept an explicit door open on tariffs targeting critical minerals, a category that includes silver and platinum. Back in January, when this was first floated, silver actually fell as the administration held off, choosing instead to pursue bilateral negotiations rather than blanket tariffs. But the language used at the time was not a closure. It was a pause, with officials stating plainly that import restrictions remained on the table if agreements were not reached in a timely manner. That door has never been shut. It has simply been left ajar for months, with the market never quite sure whether it will swing open or quietly close for good. This is why uncertainty itself has become a driver of price, separate from whatever the actual policy outcome ends up being. Markets do not wait for clarity, they price probability. And when a probability sits in that uncomfortable middle zone, not zero, not certain, somewhere in between, the market tends to build in a risk premium, a kind of insurance cost baked into the price that persists until the uncertainty resolves one way or the other. Silver, sitting at the intersection of industrial exposure to a trade war and monetary exposure to fear, is a nearly perfect candidate for that kind of premium to build. Layer on top of that the Federal Reserve, because monetary policy is the deepest current running underneath every precious metal story, always has been, going back decades. As of this week, the Fed has held its benchmark rate steady in the range of 3.12 to 3.34%. And Chair Kevin Warsh has been explicit that the central bank's primary focus remains bringing inflation fully under control, not stimulating growth, not easing conditions preemptively. Markets are currently pricing something close to a 60% probability of a rate hike, not a cut by September. Sit with that for a second because it inverts the story most people expect. The conventional wisdom is that gold and silver rally when rates are falling, when money is cheap, when the opportunity cost of holding a non-yielding asset drops. That is true historically as a general pattern, but right now we are watching silver rally 60% over 12 months during a period when the Fed is holding firm and possibly leaning toward tightening further. That should not happen under the simple textbook model. And when reality diverges from the textbook model, that divergence is always telling you something important if you are willing to listen to it. What it is telling you most likely is that the driver here is not interest rate expectations in the conventional sense. It is something deeper, a loss of confidence in the underlying value of the currency itself, independent of what the Fed does with its overnight rate. This is the difference between real interest rates and nominal interest rates, and it is one of the most important concepts in macroeconomics that almost nobody explains in plain language. A nominal interest rate is simply the number the central bank announces, the sticker price of money. A real interest rate is that number adjusted for inflation, what you actually earn after your purchasing power erodes. If inflation is running hot enough, even a Fed that is holding rates steady or even hiking them can still be delivering a real interest rate that is low or negative once you account for the pace at which prices are rising elsewhere in the economy. And when real rates are low or negative, holding gold or silver, assets that earn no yield but also cannot be devalued by a printing press, becomes rational, non-emotional. This is not fear driving the trade. This is arithmetic driving the trade. Investors doing the actual math on real returns and concluding that hard assets preserve purchasing power better than cash, sitting in an account earning a nominal yield that inflation is quietly eating alive. Now, let's bring in the currency angle directly because it connects everything we have discussed so far. The US dollar has weakened recently, even as the Fed holds a relatively hawkish stance. And that combination, hawkish central bank plus weakening currency, is unusual enough to be worth understanding. Normally, a hawkish central bank supports its currency because higher rates attract capital-seeking yield. When that relationship breaks down, when the currency weakens despite hawkish signaling, it often reflects concerns that sit above and beyond monetary policy, concerns about fiscal sustainability, about the sheer scale of government debt, about geopolitical risk, about the long-term trajectory of a nation's balance sheet, rather than its short-term interest rate decisions. A weaker dollar mechanically makes dollar-denominated commodities like gold and silver cheaper for buyers using other currencies, which increases global demand. But more importantly, a weakening currency alongside a hawkish central bank is historically one of the more reliable signals that markets are looking past the next meeting and starting to price in a longer-term erosion of confidence. This is where central bank buying enters the picture. And I want to be precise here because this trend has been building for years, not months. Central banks around the world, particularly those in emerging economies, have been accumulating gold reserves at a pace not seen in generations. This is not a mystery, and it is not a conspiracy. It is a publicly documented shift in reserve management strategy. Nations that have watched dollar-denominated assets become entangled with sanctions risk, that have watched the weaponization of the international payment system during recent geopolitical conflicts have drawn a rational conclusion that holding a neutral physical apolitical asset like gold provides a form of sovereignty that a foreign currency reserve simply cannot. This is often described as de-dollarization, though that term overstates how fast or complete the shift has been. It is more accurate to describe it as diversification away from concentration risk, a very old and very sensible instinct applied at the level of nation states rather than individual households. And while this trend is centered primarily on gold, silver benefits from the same underlying psychology, the same instinct to hold something that cannot be frozen, sanctioned, or printed into oblivion. Let's talk about geopolitics directly now, because it is impossible to discuss precious metals honestly without it. Tensions in the Middle East have escalated meaningfully in recent months with direct military exchanges between U.S. forces and Iranian-aligned groups, and control over the Strait of Hormuz, one of the most critical choke points for global energy shipping, remaining contested. Markets have responded exactly the way history would predict, with the dollar strengthening on immediate safe haven flows during acute escalation, oil prices reacting to shipping risk, and precious metals experiencing sharp, sometimes contradictory, moves as investors weigh immediate safe haven dollar demand against longer-term inflation and instability concerns. This is worth understanding deeply because geopolitical shocks do not move markets in a single clean direction. They create competing forces. Dollar strength from panic flows in the very short term, inflation concern from energy price spikes in the medium term, and erosion of confidence in global stability over the long term. Silver, sitting at that intersection of industrial and monetary demand, tends to feel every one of those competing forces almost simultaneously, which is part of why its price action can look erratic to anyone who has not mapped out the underlying causes. Now, let's step back in time, because none of this is new, and the patterns you're watching unfold today rhyme unmistakably with previous chapters in monetary history. In August of 1971, President Nixon severed the direct convertibility of the dollar into gold, an event now known as the Nixon shock. For decades prior, the dollar had been anchored to a fixed gold price, part of the Bretton Woods system established after the Second World War. When that anchor was removed, the dollar became a purely fiat currency backed by nothing but the full faith and credit of the United States government. What followed was not immediate, but it was significant. A decade defined by rising inflation, oil shocks, and a period economists now call stagflation, the uncomfortable combination of stagnant economic growth and persistently high inflation that traditional economic models struggle to explain. During that decade, gold rose from roughly $35 an ounce to over $800 at its peak. An extraordinary revaluation that reflected not gold becoming more valuable in any physical sense, but the dollar's purchasing power being reassessed in real time by a market that had lost confidence in the currency's anchor. Silver moved even more dramatically in percentage terms during that same period, precisely because of the dual nature we discussed earlier, industrial demand and monetary demand compounding on top of each other. I am not telling you this to suggest we are repeating the 1970s exactly, because we are not. The structural details of today's economy, today's debt levels, today's global trade relationships are meaningfully different. But the underlying psychological and monetary mechanics rhyme closely enough that the historical parallel is worth taking seriously rather than dismissing. When confidence in a currency's long-term purchasing power erodes, whether from persistent deficits, geopolitical instability, or policy unpredictability, capital has historically sought refuge in assets that exist outside the control of any single government. That is not a prediction of what will happen. It is a description of what has happened repeatedly across different currencies in different centuries whenever similar conditions have appeared. Let me tell you about three investors, each of them fictional, each of them designed to illustrate a lesson that real investors learn the hard way, often at significant cost. Consider someone named Daniel, 44 years old, an operations manager who had never owned a single ounce of precious metals until early this year. Daniel watched silver's headlines, watched the 60% rally, and jumped in entirely with a lump sum during a sharp spike, convinced the move was just getting started. Within weeks, silver pulled back nearly 15% on profit-taking and short-term dollar strength during a geopolitical flare-up. Daniel panicked and sold near the bottom of that pullback, only to watch the metal recover and grind higher again over the following months. Daniel's mistake was not being wrong about the long-term thesis. His mistake was entering all at once at a moment of maximum emotional conviction with no plan for volatility that is entirely normal and expected in an asset like silver. Now consider someone named Priya, 31 years old, a school teacher who took a different approach entirely. Rather than trying to time silver's exact bottom, Priya committed to buying a small fixed amount every single month, regardless of the headlines, regardless of whether the price had just spiked or just dropped. Over the course of the year, her average purchase price smoothed out considerably below the peak because she was buying steadily through both the surges and the pullbacks, rather than reacting emotionally to either. Priya's approach illustrates one of the oldest and most underappreciated truths in investing, that consistency often outperforms conviction, particularly in volatile assets, because it removes the emotional decision-making that destroys most retail investors' returns. Finally, consider someone named Robert, 67 years old, recently retired, who had held a meaningful allocation to gold for over a decade long before it became a popular headline topic. Robert did not chase silver's dramatic rally at all. He maintained his existing gold position as a portfolio stabilizer, a form of insurance rather than a speculative trade, and watched calmly as the value of that allocation rose steadily alongside everything else happening in the metals complex. Robert's outcome illustrates the difference between treating precious metals as a long-term store of value within a diversified portfolio versus treating them as a short-term trading vehicle. Neither approach is inherently wrong, but they require entirely different temperaments, entirely different time horizons, and entirely different expectations about volatility along the way. These three stories point towards something deeper, something rooted not in economics, but in human biology. And this is worth understanding because it explains why so many investors make the same mistakes across every single market cycle in history. When markets move sharply, whether up or down, the human brain activates the amygdala, the region responsible for processing fear and threat detection, faster than it activates the prefrontal cortex, the region responsible for rational, deliberate analysis. This is not a character flaw. It is evolutionary wiring built over millions of years to help our ancestors react instantly to physical danger. A wiring system that unfortunately does not distinguish particularly well between a predator in the grass and a 15% drawdown in a silver position. During sharp declines, the brain's threat response floods the body with cortisol, driving an urge to eliminate the perceived danger immediately, which in financial terms means selling, often at exactly the worst possible moment. During sharp rallies, a different chemical process takes over, dopamine-driven anticipation of reward, the same neurological pathway implicated in gambling behavior, which drives an urge to buy more, to chase, to increase exposure precisely when prices are least attractive relative to their long-term value. Understanding this is not just interesting trivia. It is genuinely practical because recognizing that your urge to sell during a panic or buy during euphoria is a biological reflex rather than a reasoned conclusion gives you the ability to pause, breathe, and make a decision based on your actual strategy rather than your nervous system's ancient threat detection software. If this framework is helping you see the current environment more clearly, take a moment now to like this video and subscribe, because everything we have covered so far, the tariff uncertainty, the Fed's positioning, the currency dynamics, the central bank buying, the historical parallels, and the psychology of decision-making is about to come together into a single final insight that ties the entire picture together. And I promise it will change how you think about the rest of this year. Stay with me until the end. Before we move to debt and liquidity, there is one more relationship worth understanding because it is the kind of detail that tells you how a market is actually thinking beneath the surface of the daily price. It is called the gold-silver ratio, and it simply measures how many ounces of silver it takes to buy 1 ounce of gold. Right now, that ratio sits in the low 70s, meaning it takes somewhere around 70 ounces of silver to equal the value of a single ounce of gold. Historically, this ratio has swung across a wide range, sometimes falling into the 30s or 40s during periods when silver dramatically outperforms gold, and sometimes climbing above 80 or even 90 during periods when investors favor gold's stability over silver's volatility. What makes this ratio useful is not any single number, but the direction it moves and why. A falling ratio tells you silver is outperforming gold, typically because investors are gaining confidence, willing to take on more industrial and volatility exposure in pursuit of higher returns. A rising ratio tells you the opposite. The capital is retreating toward gold's relative safety, even within the precious metals complex itself. Over the past year, even with silver's dramatic 60% climb, the ratio has remained relatively wide, which tells a careful observer something